Things are really starting to look like Bear Stearns with their hedge funds having problems in 2007. This story just came out in the last 24 hours. It was broke by reporter Nell McKenzie at risk.net. So this is a hedge fund website, and according to this reporter, JP Morgan is warning its hedge fund clients that they will start doing up to 7 times per day margin call checks. And this is to prevent something like another Archegos. Here is the problem. There is already way too much margin debt, way too much credit, way too much leverage. These hedge funds and family offices in a lot of cases are retired hedge fund managers that stopped producing good returns and were put out to pasture. So after a hedge fund manager stops producing amazing returns, then all of a sudden it switches to a family office. So these investment banks like Credit Suisse and others, it's come out over the last 6 or 7 months that Credit Suisse loaned just to Archegos around $30 billion in credit. So they can put on these over-leveraged trades, and in these hedge funds and family offices also went into the repo market because interest rates were cheap and went and borrowed to leverage up trades even more, probably to buy junk bonds, considering how many junk bonds are being sold and how junk bonds are acting so crazy lately. I'm sure long junk bonds also long the leverage short vol trade. So there is already way too much leverage and credit in the system, and for these large banks like JP Morgan and others to try to do margin calls now is probably too late. To try to put risk controls in ex post facto, which means after the fact, after they already gave out insane amounts of credit, leverage, margin debt for these hedge funds and family offices to put on insanely leveraged trades where a quarter point interest rate hike or a move in the US Treasury yield curve or the VIX moving up can blow up a trade and cause contagion at more than one large hedge fund. So a bunch of large hedge funds to fail, and then there's counterparty risk, and it just starts rolling, like in 2007 and 2008, or what happened in February and March of 2020. One more thing I also wanted to point out before I end this short little video was how, despite the fact that Credit Suisse gave out almost $30 billion in credit to Archegos, as far as I know, I've only seen in public that they've written off about $7 billion in debt. So I don't know if the Fed bailed them out or the European Central Bank bailed them out or it was swept under the rug. But I'm sure there are a lot more hedge funds and family offices with similar leverage and debt problems where they borrowed way too much, either margin debt from the bank itself, from their clearinghouse, like a JP Morgan or Goldman Sachs, or they went in and borrowed in the repo market and then they couldn't pay back their repo funds, because that's some of the problems that hedge funds and large banks had in 2008, whether it was Bear Stearns and Lehman Brothers, or more recently in February and March of 2020, when the bond and credit markets totally froze up. And the Fed had to step in, and at least for a while, they had to issue press releases and guarantee everything globally. That's how big of a mess things were in February and March of 2020. Finally, if you like content like this and want to help keep content like this free so it doesn't all end up behind a paywall, or you want far more in-depth research content, information, financial education, and analysis, and trust me, the articles behind the paywall are far more in-depth than these short little videos. There is over 170 articles, charts, and audio podcasts behind the paywall, including 17 new articles out in the last 7 or so weeks on a lot of interesting topics about global macro companies and sectors. My latest article, which just came out in the last hour or so, is about First Majestic Silver and the guidance that they announced. Now, the press releases that were available on Kitco and on the First Majestic Silver Company website, they showed enormous production growth. But if you look at the First Majestic Silver stock, since really early June, it has not done very well. I highlight in the article, in my opinion, why it hasn't done very well, and it wasn't mentioned in the press release. So if you want to see why, if you're a First Majestic Silver shareholder and wondering why your First Majestic Silver shares are not doing well despite record production growth in gold and silver mining, then for only $5 a month, you can sign up for my Patreon. It is one of the best deals out there. I think I charge less than anyone else in my space for premium content, only $5 a month. Normally people charge way, way more than that. If you don't like it, you can always cancel, but I think you're really going to like it. And thank you for listening. So bottom line here, we have large banks like JP Morgan worried about how much debt and credit they've given out to hedge funds and family offices for these leveraged trades, whether that's the leveraged short vol trade or leveraging up junk bonds or God knows what else, whether that's leveraged trades on stocks, bonds, currencies, commodities, derivatives, who knows? It's probably a mix of all these things. And this is why the system is so fragile. There is way too much debt. There is way too much leverage on these trades. The system, the last 16 months, has added even more leverage, even more debt. It shouldn't have, but yet that's the Ponzi scheme, the Ponzi system, the fiat currency and credit Ponzi scheme with these over-leveraged trades that we have. Because when things get bad enough, the Fed will guarantee your backstop, now even large hedge funds. And it's just gone worse and worse and worse with the Fed guaranteeing more things or issuing press releases that they're going to guarantee things since I started covering all this in 2008 and 2009.